Hi everyone, this is TJ with the Counterpunch Trader. I thought I would do a walkthrough of some trades over the last couple days. December has started out really great, some excellent swings and great trading in our favorite markets, and I want to walk through some of these. So I'm going to do kind of a mix of CPT and CPX. I've got the Counterpunch Trader calculator, but I've set it up CPX style. In other words, no trade tracking. So you just get the setups. And I also turned off the key level adjustments so that we can talk through, and I'll show you what that looks like. So if you're on CPT or CPX, they were basically the same trades that happened. Starting with crude oil, yesterday on the 1st, you'll know that we start at 850. Let me just back this up a little. So it's almost 850, and there's a trade that's in play here, but it's already gone too far from 58 to 63. No, it could come down and get us in sync, but then it stabs up and goes too far, hitting its second target. So we're going to look for another trade, and there's one right here at 850. And the entry is at 50.68. It does trigger in, and that is the exact same trade as CPT. There's no key level adjustments to be made, except for the stop. Notice the stop is at 55. You would want to put your stop at 54. Hopefully you've been learning about working around fives and zeros on many markets like crude oil, for example. So you just move your stop down and make a one-tick adjustment like this. And that's what CPT would do for you automatically. But with CPX, it's very simple. You just make the adjustment manually. It's no big deal. Same trade. And it's going to meander about. And you do have a possible short. And the short is at 62. Now, when we have a stop and reverse potential, what we do is we adjust the entry 2 ticks lower and then work around key levels. So if we push that down to 60, 60 is a key level. So the stop and reverse would be at 5.9. So that's the stop and reverse level. If it hits 5.9, you should have an order in where you've moved this stop up to 5.9 and you have a reversing sell order to go short. Okay? And it does push through the entry, but this is a case of it shows perfectly why we make these kind of adjustments, because the whole principle is we want to protect the trade we're in while also respecting the fact that the market can be turning. It might be turning in the other direction. Momentum is below the signal line. The histogram has turned south. You got a setup, but that could be, just a normal wiggle, or, just part of the everyday up, stair-stepping to a greater trend. So we make the additional adjustment. And like this, we protected our long trade. It does push higher, and it pushes right on through to full target. Okay, and at this point, you want to move your stop up. You want to lock in your one tick and start trailing the signal line on up. With every bar that closes, you're moving this up, staying 2 ticks below the signal line minus key level adjustment. So on this next bar here, 78, 2 ticks below is 76. You put your stop at 74, right? Because you have to work around that 5. It goes up a little higher. Signal line's at 78 still. Keep your stop at 74. Now it starts moving higher. It goes up to 80. You can move your stop up to 78, and so forth and so on, until it finally goes all the way up to here. Let's see, it closes on the last bar to close above is this one, 92. So the stop actually moves all the way up to 89. That goes to 89 right there. And it doesn't stop out yet until here. So not a bad trade. One and done. All right, so that leads us to today's trade. Here we are trying to get to 850, 840, 844, 846. And then instead we get a short trade here. It's 848, 849. And that's 853. Now, it did touch the entry, but when I have a bar that has already touched the entry or maybe went a little bit beyond it, I'm going to now try to ask for extra confirmation and make a little adjustment below the spike, see? Now that's an entry at 74, so I'll put my entry in at 73, and look what happens. So far, it hasn't touched 73, but you see the sense in making the one tick adjustment, because this happened before a start time, and the price bars show you near-term support and resistance levels when you see the price rejected off of there. So a one tick adjustment, why would you want to get short on the very price that it wasn't able to push through when you can make a one tick adjustment and at least force the price to get through that level? And on 5 attempts, it wasn't able to. And look at that, you see? It saves a losing trade because instead, you go long right here. And there's no stop and reverse because you're not in a trade. You don't need to make an adjustment. You get in at 50.88. Okay, you're going to 5104. And see what happens. One and done. So if you did not listen to what the price action was telling you, remember, it's okay to make these small adjustments. Now, even if you didn't make it off of these lines here, these bars, if you look to your left, you also have this little spike. And it wouldn't bother me if you wanted to put your original trade entry 2 ticks down to get below this price rejection here. Either way, the writing is on the wall. You could see it if you just pay attention to the chart. All right, so one and done on crude. The Russell had a spectacular week as well with our 8-tick range bar. It just hit new record profit levels in a big way. Let's look through the last couple days. Hopefully this is not the last hurrah for the Russell because they are changing the way they price their this futures contract. And instead of it being $100 a point and $10 a tick, and I believe this is going to start Monday, if I read the news correctly, it will soon be, or it's going to be $50 a point and $5 a tick. So who knows how that's going to change how this trades. We may have to look at a different chart altogether and give it some time. But for now, if this is the last hurrah, it was one heck of a goodbye or swan song. You've got a setup here. And it's right at 9:29, but it remains valid at 9:30, right? There's nothing that changes the rules. Remember, trade tracking is off like CPX. So that's a perfect short trade, 1326.8, and this is just standard fare. You've got some nice additional add-on trades. Remember, we're just focused on the trade we're in. So when it comes down and hits target 1, remember, you got to move your stop. The stop is at 1329. Don't forget, 1329.1, you make a key level adjustment. But when it hits target 1, you're moving your stop, locking in a tick, and you're starting to work around the signal line. So 1326.7, which is the 1 tick lock in, and it comes up and stops out for 1 tick. Okay, and target 1, I mean, that's a profit level if you want to take profit on these larger trades at 16 ticks, depending on how many positions you're trading. But it needs 2 target 1 winners or 1 target 2 winner and a positive result for power of quitting. So it doesn't get long here. Instead, it pushes through and comes down, and you can get in sync. Now, this is one way to trade. You can either wait for a new setup, but what I like to do is get in sync with this add-on trade right there. Because even though we were in the white trade, this trade triggered in. The stop is up here, and so it never stopped out. Target 1 is down here. It never hit target 1, so it's still a trade you can get in sync with. I mean, why not? So it pushes through and gets in right there at 1325.7. Now, that's the way I like to do it. You could also wait for a new setup, in which case you'd be taking this one. And I would make a 1 tick adjustment to get below the 200 EMA. I don't know if I would adjust it all the way down to here. I mean, you could. It just depends. I personally don't like to make more than 1 or 2 tick adjustments, especially on a, what seems to be a clear trend. Maybe on a choppy sideways market, I will do that, but not on a market that looks like it's just starting to step lower. And you can see that by the exhaustion dots moving lower, the price moving lower, the high trend moving lower. Okay, so whether you take this trade or this trade, do it the same way every time. If you're going to take the past get in sync trade, do that every time. Don't just do it once and then if it doesn't work tomorrow or the next day, you do it another way. You need to get a good sample set. In fact, it should be part of your back testing. Anyway, regardless, the trend was down. Target 1 is reached here. Going to move that stop down, lock in a tick, start trailing the signal line. This target 1 was also reached. Either way, it's going to be power of quitting. Here you go, hitting target 2 on the get in sync trade. See that right there? Target 2. This trade here, the target's slightly lower, and it gets as, target 2 is at 0.7, and it gets as low as 0.9. So it misses by 2 ticks on a 25 tick trade. So inside of 90%, closer than 90% of the way. If you want to take profit at target 1, you can. Otherwise, you're trailing the signal line right here, and you're stopping out. Either way, a nice result. But I think that if you get all the way to target 2 and miss, you get more than 90% of the way, I don't think you want to let the price come all the way back up and take away most of your profits. You have to trade for profit. Of course, the earlier trade had the slightly higher entry and the bigger targets, 28 ticks, and higher up. And in other words, it got there first. Look how perfect that trade was. This is a good example of why I like to get in sync with trades that happened while we were already in a trade, if I need to. Okay, because the rules are if it hasn't stopped out or if it hasn't hit target 1, you can get in sync. So I'm not going to second guess that. I'm just going to follow it. It works when it works. Every now and then it won't, but I think it works well enough. Whereas you want to live with that or, use that approach. So let's see what happened today. Remember, 9:30. All right, so here we are, and this is a good learning session if you're using CPX and why we use key level adjustments and make the adjustments the way we do. So it's important you learn from this example. There's a long trade here right at 9:30, 1314.7. Does trigger in. If it happened too fast for you, that was all within 2 seconds, you have an order that hasn't been filled yet, and it will come down and fill you 2 bars later. Okay, so within 15 seconds or so, you should be in that trade. Pretty choppy pre-market action here, something to be a little concerned with, but you never know once the market's open. You just have to go with it, be confident. There's another setup here. Not yet interested in that because we're in this one, right? Then you have a short trade, and notice that that's at 1314.1. So we never get short at 0.1 on the Russell. We adjust it down to 1313.9. So it helps to put a marker at 0.9, which is right there. Now, that's where the entry should be. Not only that, notice that to your left at 0.9, you have a spike. So you probably want to work around that to 0.8. On the other hand, you also have a stop and reversal. So you want to make a 2-tick adjustment anyway. So you're going to go down to 0.7, just like we did on crude oil. We're not making a 2-tick adjustment from this entry because that's a 0.1 and that's never an entry on the Russell. You always make the key level adjustment to 0.9. Then you make the stop and reverse adjustment. So 0.7, 1313.7 is your stop and reverse level. So we're still long. It pushes through and it looks like, notice that it stops, it gets as low as 0.8. See, 0.8? There's our stop and reverse. Once that bar pushes through, now there's a new setup. See the new setup? Remember, we always go with the newest setup. So this new setup actually cancels the old setup. So now we have an entry at 1313.6. And 13.6, you adjust down to 0.4. Okay, this is how I do it. Now we have a stop and reverse adjustment, which is going to push that all the way down to 0.2. Okay, maybe I'm going to end up losing more if this continues to go down. But the principle is I want to protect the trade I'm in while respecting the fact that the market could be going lower, and I always go with the newest trade. So I'm just applying the same rules to the newer trade. It's a moot point because it never gets lower than 0.8. Never gets to the 0.7 level. Okay? So instead, look, it does come down and hit 0.7 right here. You see? But again, like I said, the new trade cancels the old trade, and then I make my key level adjustment and then my stop and reverse adjustment. A lot of times you don't have to make a key level adjustment, then you make the stop and reverse adjustment, and then you have to make a key level adjustment. The idea is you want to try to stay in your original trade, and it ultimately comes up and hits its target. You see that? This is how, look at how choppy that is. This is my way of navigating around choppy price action. It's how I do it. It's target 3. Meanwhile, the trailer is coming up, trailing up higher. The stop would be at 0.2. 0.2 is right there. And it stops out 0.2. So again, one and done. If you navigate through this properly, you want to give the trade room to develop. You know it's wiggling around some. You also got the 50 EMA pushing up and getting above the 200. The histogram can't get to the red. You know, I'm not really looking at that so much as just trying to stay within my trade setups and make my adjustments as per the trade plan. So the Russell one and done, and hopefully you learned something from this too. Protect the trade you're in while respecting the fact the market might turn.